We have entered the first week of September. This is a month that has historically been a tough one for stocks. And so far, our next guest, or our guest, the guest of the day, says the market's been trading at its fair value. So are there opportunities for investors heading into the fall? David Sequeira, Chief U.S. Market Strategist with Morningstar Research. Great to see you again, David.
Good afternoon, Greg. How you doing?
Not too bad. Let's talk about that bad reputation that September has historically made for itself. Or also, you think at fair value right now. What are the big themes in the market?
Well, we shall see what September ends up bringing us, but it's already been a volatile year. When I think back, we started off the year with the big sell-off and all the overvalued and overextended AI names once DeepSeek, hit the headlines. That was then further exacerbated by the tariffs, which ended up pushing the market down too far in our view. We actually moved to an overweight recommendation on the April 7th episode of The Morning Filter, which is my weekly podcast. And then since then, the market has rallied after it realized, it wasn't going to be the economic apocalypse everyone initially had thought it was going to be. AI spending has really been able to hold up, the U.S. economy and the stock market, ever since. So at this point, as you mentioned, now we're back at fair value compared to a composite of the stocks that we cover that trade on U.S. exchanges. So the question is, what's really changing? So what we saw in August is really a broadening out of the returns, across the market, moving away from those, big mega cap AI stocks into those areas that had lagged, the market to the upside. So we saw small caps outperform. They're up 4.58% last month, well ahead of large and mid caps, which were both up about 2%. And value stocks also caught a bid. They were up over 5%, whereas growth stocks were only up 0.4%. So I think we're seeing a lot of indications that valuations for those, mega cap growth AI stocks are getting to be pretty high, and momentum is definitely running out in those areas.
I think when you do end up in a market situation like this, because it has been choppy, but we're not that far off of all-time highs for the S&P 500, you feel that the market is fairly valued at this level. You mentioned small caps. Is this one of the pockets of opportunities? Are there opportunities?
Yeah, I think we've talked about small caps for probably well over a year now, Greg, every time that we've chatted about the market. And we've always noted that from our valuation standpoint, small caps were well undervalued, both on an absolute basis as well as a relative value basis. But the investing in small caps is, an investment and not a trade. Now, historically, small caps tend to do well when you're in an environment where economic growth is starting to reaccelerate after either a slowdown or a recession. The Fed's easing monetary policy and long-term interest rates, are coming down. And, that had not been the environment for, at least the past year, if not past, year and a half. But we thought that investors, should be attracted to those small caps and probably overweight those because, again, you can never really perfectly time when to get in. And the thing I've always noted about small caps in the past is it doesn't take that much of a rotation out of large and mid cap into small cap for small caps really to rally very quickly. And if you're not already invested in those small caps, you could miss it to the upside. So at this point, what I think the market is looking at is, at least two of those three conditions are now being met. So we expect the Fed to start easing here at the September meeting. Our economic team looking for at least one more cut this year, 100 basis points of cuts to the Fed funds rate over the course of next year. Long-term interest rates have been on a downward trend for the past couple of weeks, if not the past month or so. Our U.S. economics team is projecting an average 3.9% for the U.S. 10-year over the course of 2026 and falling all the way down to 3.5% in 2027. So that just really leaves the question, what is the path for the U.S. economy? And unfortunately, that question is extremely hard to answer right now. So if you looked at the headline GDP print in the first quarter, that was negative. It was then positive in the second quarter. That would then meet that third condition that we really need for small caps to rally. But of course, that was very distorted by the pull forward he had in the first quarter as importers were front running all of the tariffs. At this point, looking forward, the Atlanta Fed GDP Now figure, which is a measure, which is really a run rate based on economic metrics as they come out, that's pointing to a 3% growth rate here in the third quarter. Now, our economic team thinks that's too high. They're looking for actually a sequential slowdown over the next couple of quarters. So at this point for investors, I still think you should probably remain overweight small caps overall. They trade at a 15% discount to a composite of our fair values. But I think you're going to need to have, a strong hand. And if we do see some near-term, downward volatility, I think you need to be able to hold those, through that volatility until we really get all three of those conditions lining up, which if it's not now, we think probably is going to be by early to mid next year.
All right, so interesting to take a look at the small caps area, do some more research there. What about sectors? You mentioned the fact that the tech trade may look like it's getting played out. What specific sectors are you looking at?
Well, first of all, is communications. That's a sector I think you and I have talked about for well over a year. It's been one of the most, if not the most, undervalued sector over the past year. In fact, I believe that was as low as like a 32% undervalued level, last April. And part of the reason had been because, Alphabet and Meta, are well over 50% of the composite of that index by market cap. Two stocks that we had long thought had been undervalued. Meta moved up earlier this year, and now we're seeing Alphabet up. I think Alphabet was up 9% yesterday after the court ruling. So communications overall probably now pretty close to fairly valued from a sector perspective, but we still see a lot of value in a lot of the traditional media and communication names. Verizon would be one that I would highlight for investors to take a look at. Now, thinking forward with the Fed poised to start cutting interest rates, I'd highlight real estate. That's a 7% undervalued sector. Personally, I'd still steer clear of urban office space. I don't necessarily like the risk reward dynamics there, but for tenants that have more defensive characteristics, I think that's a good play for kind of the next couple of months. Healthcare also at a 6% discount. That sector's been under a lot of pressure. It may even actually be the worst performing sector, year to date. Now, within that sector, I prefer medical devices and med tech, over the pharma names. But if you're going to be involved in that, I would look towards names like, Bristol Myers, which in our view are deep value names. And then lastly, energy. Energy trades at a 4% discount. I think it just provides a good natural hedge in your portfolio for any additional geopolitical risk or if inflation were to make a meaningful comeback. And with the Fed cutting rates, over time, that should increase the demand for energy as the economy, starts ramping back up. So we see a lot of value in that sector. Then some of the subsectors I'll just end with are going to be the food companies. We see a lot of consumer packaged group companies very undervalued. And then home builders, building products should also do well with the Fed cutting rates. And unfortunately, the defense industry is still a long tailwind behind that one. See a lot of value there.
What is the greatest risk to your thesis then? Is it the Fed simply not playing along with the market expectations?
Well, it would certainly be a big risk to the market here in the short term. The market is definitely pricing in not only, the one rate cut in September, but two, and now it looks like even up to three rate cuts, this year. So if they were not to cut rates, that would be a big surprise to the market. And I think that would end up hurting a lot of these sectors that we think are undervalued today because we are looking for those rate cuts.